Have you ever asked yourself why silver is trading at less than half of its 1980 high, while the global money supply has expanded by thousands of percent? It is a mathematical anomaly that shouldn't exist. If you adjust for real inflation, using the same CPI metrics the government used in the 1980s, silver shouldn't be sitting at $20 or $30 today. It should be trading at $71. So why isn't it? Why is the most indispensable metal of the digital age priced as if it were abundant, when the geological data suggests we are running out? Most investors look at the chart and see a dead asset. But the few who understand the mechanics of the COMEX and the global supply chain see something else entirely. They see a coiled spring that is being artificially compressed. And when that compression ends, the price discovery will be violent. To understand why silver is currently mispriced, we must first strip away the noise of daily volatility and look at the structural role the metal plays in the modern world. For thousands of years, silver was money. It was the transaction currency of empires, from Rome to China to the early United States. But in the modern era, silver has transformed. It is no longer just a store of value, it has become a strategic industrial necessity. We are currently living through a transition that is often termed the Green Revolution, or the electrification of everything. Governments across the United States, Europe, and Asia are mandating a shift away from fossil fuels toward renewable energy and electric vehicles. This is not a political debate. It is a legislated reality with trillions of dollars in capital allocation behind it. Here is the problem that few policymakers discuss. None of this technology works without silver. Silver is the most conductive metal on the periodic table. It conducts electricity more efficiently than copper and more efficiently than gold. It is the best reflector of visible light. It is thermally conductive and resistant to corrosion. Because of these unique chemical properties, silver is the critical ingredient in photovoltaic solar cells, electric vehicle contacts, 5G telecommunication towers, and advanced guidance systems for defense. We are entering a period where the demand for silver is shifting from optional to mandatory. You can print currency, but you cannot print a metal that requires complex geology and massive energy inputs to extract. The global economy is attempting to build a 21st century infrastructure on a supply base that is struggling to maintain 20th century levels of production. This is the definition of a supply shock, and yet the price remains suppressed. To understand why, we have to look at the mechanics of how price is discovered and why the current system is mathematically unsustainable. In a normal market, when demand rises, prices rise, and producers rush to create more supply. If the price of corn goes up, farmers plant more corn. If the price of oil spikes, energy companies drill more wells. Silver is different. It possesses a unique economic characteristic known as supply inelasticity. Approximately 70% of the world's silver is not mined directly. It is a byproduct. It comes out of the ground as a secondary element when mining for copper, lead, and zinc. A copper miner does not care about the price of silver. Their operations are dictated by the global demand for copper. If the price of silver doubles, the copper miner cannot simply flip a switch to produce more silver, because the silver output is geologically tied to the copper output. This means that even if the price of silver were to surge to $100 an ounce, the global supply would not immediately respond. We are facing a situation where demand is exponential, driven by the solar and EV industries, while supply is capped by geology and the economics of base metal mining. Let's look specifically at the solar industry. In just the last decade, the photovoltaic sector has gone from consuming a negligible amount of silver to consuming nearly 15 to 20% of the annual global supply. Newer solar technologies, such as TOPCon and HJT cells, are more efficient but require significantly more silver per unit than previous generations. As Germany, China, and the US race to meet net zero targets, the solar industry alone is on track to consume potentially half of the annual global mine supply within the next decade. This is a mathematical impossibility under the current pricing structure. The market is currently in a structural deficit. For the last 3 consecutive years, the world has consumed more silver than it has produced. Above-ground stockpiles are being drained to meet this deficit. While the industrial argument is compelling, the monetary argument is perhaps even more powerful. Throughout history, the ratio between gold and silver prices has averaged around 15 to 1. This represents the geological occurrence of the two metals in the Earth's crust. For every ounce of gold you find, you typically find roughly 15 ounces of silver. Today, that ratio fluctuates wildly, often sitting between 80 to 1 or even 90 to 1. This suggests that relative to gold, silver is historically cheap. If gold is the currency of central banks, silver is the currency of the people. And currently, the market is pricing silver as if it were an abundant industrial commodity rather than a scarce monetary metal. Smart capital is watching this ratio. When the ratio is high, it historically signals a massive buying opportunity. We are seeing signs that liquidity is beginning to move. If the supply is falling and demand is rising, why hasn't the price exploded? This is the question that confuses most retail investors. The answer lies in the structure of the modern financial markets, the divide between paper silver and physical silver. The price of silver that you see on your screen, the spot price, is not determined by the exchange of physical bars in a vault. It is primarily determined by the trading of futures contracts on the COMEX in New York and the LBMA in London. In these markets, vast amounts of paper silver are traded every day. These contracts represent a claim on silver, but they are rarely settled in metal. They are settled in cash. Financial institutions and bullion banks can sell unlimited amounts of paper silver contracts to hedge their positions or manage volatility. This creates a situation where the paper supply of silver can be expanded infinitely, regardless of how much physical metal actually exists in the warehouses. For years, this mechanism has allowed the price to be managed. It absorbs demand. When investors want exposure to silver, they often buy an ETF or a futures contract, which diverts capital away from the physical market. It creates the illusion of ample supply. However, there is a limit to this game. The hidden layer of this story is the rapid depletion of the registered inventories at the COMEX and the LBMA. Registered inventory is the metal that is actually available for delivery against futures contracts. Over the last 3 years, we have seen a precipitous drop in these stockpiles. The metal is leaving the Western financial system and moving east. This is the geopolitical angle that mainstream narratives often miss. China and India are not buying paper derivatives. They are importing physical metal. The Shanghai Gold Exchange often trades silver at a premium compared to the London and New York prices. This arbitrage creates a vacuum, sucking physical bars out of Western vaults and sending them to Asia, where they are consumed by industry or stored as strategic reserves. We are approaching a breaking point known as a delivery failure or a force majeure. If the holders of paper contracts lose confidence in the system and stand for delivery of the physical metal, the exchanges will not have enough silver to satisfy the claims. At that moment, the paper price and the physical price will decouple. The paper price may crash or become irrelevant, while the cost to actually acquire physical silver will skyrocket. This has happened in other commodities like nickel, and the structural setup for silver is even more precarious. Furthermore, large institutions are beginning to realize the fragility of the fiat currency system. With global debt levels at unsustainable highs, central banks are trapped. They cannot raise interest rates high enough to combat inflation without bankrupting their own governments. In this environment of financial repression, hard assets become the only refuge. Gold moves first, as it is the primary reserve asset. But silver, being a smaller, less liquid market, moves faster and further once the momentum shifts. The market cap of the entire silver sector is incredibly small. To put it in perspective, the value of all the investment-grade silver available above ground is less than the market capitalization of a single mid-tier technology company. If a fraction of the capital currently parked in bonds or tech stocks decides to rotate into silver, there is simply not enough metal to accommodate the inflow at current prices. The only variable that can change is the price. We are staring at a perfect storm. On one side, we have the geological reality, declining ore grades, a lack of new discoveries, and a rigid, inelastic supply chain. On the other side, we have the industrial reality, an explosive, government-mandated demand for solar energy and electrification that cannot function without this specific metal. And sitting on top of it all is the monetary reality, a paper pricing mechanism that has divorced itself from the physical world, creating an illusion of abundance while the vaults are being quietly drained by the East. The price of silver at $25 or $30 is an artifact of a financial system that prioritizes liquidity over reality. It is a temporary distortion. When the market finally acknowledges the scarcity of the physical metal, whether through a failure in the futures market or a panic rush for industrial inventory, the repricing will not be a slow climb. It will be a repricing of reality itself. In the end, this isn't about markets going up or down. It's about who holds the paper promises and who holds the asset. The window to understand this distinction is closing.